J. Anthony Boeckh, The Great Reflation, How Investors Can Profit from the New World of Money. Welcome to the summary of The Great Reflation, How Investors Can Profit from the New World of Money by J. Anthony Boeckh. This book examines the U.S. government's response to the 2008 to 2009 Great Recession, highlighting the implications of massive spending and bailouts on both the American economy and global financial stability. This summary will explore the concept of the Great Reflation and the potential instability it presents, including the risks of private and public debt, a shaky world economy, and the impact these factors have on investments. Additionally, readers can expect to gain insight into the history of currency backing and the consequences of unchecked fiat money systems for long-term economic prospects.
The Great Reflation. The U.S. government responded to the Great Recession with massive spending to prevent a depression, but the long-term effects remain uncertain. The influx of money into the economy could lead to inflation and instability, as seen in past bubbles. The government's ability to halt a meltdown with money does not guarantee steady economic progress. A combination of wise economic and political decisions is needed for stability. Investors must monitor indicators to preserve their capital. The risks of fiat money. The summary explores the risks of fiat money as a root cause of the financial crises, hyperinflation, bubbles, and deficits in the U.S. and globally since World War I. It highlights how detached, debt-ridden, and inflationary economies could hit a brick wall, risking systemic failures, deep recessions, and stagflation. The summary also analyzes how the government and private creditors, debtors, and investors are balancing their interests in a fragile and uncertain economic environment. The Great Reflation Experiment and Wealth Preservation. The Great Reflation experiment is underway, and change is the new normal. In this uncertain fiscal future, the most important goal for investors is wealth preservation through cautious and persistent planning. Following the crowd is not the way to go. While certain assets will experience booms, they will be short-lived and dangerous. To prepare for investing, determine your financial goals, risk tolerance, and investment horizon. Identifying which assets to invest in what proportions, and when to adjust your strategy is key. As America recovers, diversification is still crucial, with the discipline of proper asset allocation protecting in selecting your investments. As central banks buy gold and inflation hedges while creating paper money, the importance of the prudent investment strategy cannot be overstated. Investment tools and strategies. Good quality stocks can benefit almost every portfolio. Over a 10-year span, the stock market offers greater returns than bonds at less risk. The stock market shows a better average increase in bull markets than a decrease in bear markets. Use 4 tools to decide when and how to increase or decrease exposure to equities, money, credit and liquidity, valuation, psychology, and statistical analysis. In addition to stocks, consider evaluating bonds, the US dollar, gold, commodities, and real estate. While bonds offer a solid income to the portfolio, the credit quality of the bond issuer and bond tenor should be evaluated. Treasury inflation-protected securities, TIPS, can act as a hedge against inflation. The US dollar remains the planet's reserve currency and continues to hold value despite the country's economic situation. Gold is an inflation hedge, though treasury bonds are better for investment. Commodities are attractive because they tend to be negatively correlated to stocks and bonds and can be invested in through various index contracts, funds, and ETFs. Real estate prices are unpredictable and may not be a wise investment option. Troubled prospects for the U.S. economy. Modern economic uncertainties have exposed the U.S.'s structural weaknesses, including public debt, an aging population, and declining manufacturing. This book suggests that investments in leading industries such as technology and energy, along with cost-cutting measures and tax increases, will be key to rebuilding the economy. The author also advises investors to consider equities of firms in commodity-producing nations or small companies working with alternative technologies for the best returns.
As we conclude our summary of The Great Reflation, how investors can profit from the new world of money, we recognize that the U.S. government's unprecedented response to the 2008 to 2009 financial crisis has indeed stopped an immediate economic meltdown but holds significant risks for future financial stability. With governments worldwide contending with debt, inflation, and potential catastrophe, the need for wise and proactive decision-making is essential. As an investor, wealth preservation should be the chief goal during these uncertain times. By understanding the implications of the Great Reflation, monitoring economic trends, and leveraging strategies like proper asset allocation, diversification, and timing adjustments, investors can better protect their capital and adapt to the ever-changing economic landscape.